In today's video, I'm going to show you how I am hedging my investment portfolio. Hello and welcome here at My First Million, where we are achieving our financial goals together. Yes, so in today's video, we are talking about hedging an investment portfolio. Especially, I will show you my strategy. It's nothing fancy, nothing complicated. I like to take a keep it simple approach, especially when it comes to hedging, which you, in my opinion, can way too overcomplicate if you want. But first, before I show my hedging strategy, we want to take a look first at the definition. What does hedging really means? So when we Google it, there's several different meanings when it comes to the verb hedge, to hedge something. And what we are taking a look at, or in general when we talk about investing, it's the third definition that is applying. So to hedge something means you protect oneself against loss on a bet or investment by making balancing or compensating transactions. So what does this mean in essential? If you're buying, for instance, a stock, you're betting that the stock will go up. Or maybe this is also your long-term investment thesis, that over time the stock is going up. But at the same time, maybe you have some fear that the stock market is crashing, or this particular stock is crashing. And as we all know, the stock markets can be very volatile. It can go up sometimes, and sometimes it can go down again. So in order to control the fear, there are hedging strategies out there where you buy a long position, so you buy the stock and hope that it will go up over time. But at the same time, you do a countermeasure that if the stock is falling, you limit your loss potential. So you will pay some money or do some transactions, and if the stock is falling, you will not lose too much. So taking this definition into consideration, what I'm doing is not pure hedging. So it's not by the definition that I'm hedging my portfolio. But I believe my strategy still works pretty well for hedging the downward risks. With the example that I just explained to you, that you want to protect yourself from the downside. It's already sounding pretty complicated. And actually, I think especially for beginners, many hedging strategies sound very complicated. And they are also a little bit complicated. So one thing that you hear some people doing is, in order to get some protection, maybe they will buy an inverted ETF. An inverted ETF is going up when the stock market is crashing and is going down when the stock market is going up. So again, you will have a counterbalance to your long positions if you buy something like the SDAO, which is the inverted ETF on the Dow 30. So I never personally use this kind of hedging position. And in general, I don't see myself using this, at least nowhere in the near-term future. But I have heard that, for instance, Jeremy from the Financial Education channel is using this to hedge his positions. However, you can see here from the long-term stock charts of the SDAO, what is the general trend if you are buying the SDAO as a hedge. You can see it's generally going down. There are from time to time spikes up when there are some events happening. For instance, nearly not seeable because this is a long-term chart, is the COVID crash, which provided quite a significant spike here after the year 2020. However, over time you can see it's going down. So this strategy only works in the very short-term situation. So an SDAO only works if you buy the SDAO now and in the very near-term future the stock market is crashing, then your SDAO is spiking up. But it's not a long-term position that you want to hold, because after spiking, the SDAO is spiking, you want to sell it, and because on the long-term horizon it will most certainly go down again. So if you're following along this channel, I am usually in long-term positions, investment positions. So therefore, I'm not a fan of any short-term activity. And therefore, something like a SDAO is nothing that I would like to take into consideration. Because in contrast, you can also say, so before we had the SDAO going down, which is the inverted Dow Jones Industrial Average. Why it's going down? Because on the long-term horizon, the Dow Jones Industrial Average is climbing. So over a long period of time, the stock markets are going up and to the right. So there's no real reason, no financially sound reason to long-term invest into an instrument like the SDAO. And this one here leads me to the first strategy that I am following to hedge my positions. I basically follow 3 rules to hedge my positions. And this one here is the first one. In order to protect myself from any downward cycle, is I just have a very long time horizon. I just invest for the very long time, for not just for the next few years, but for the next decades. And if you invest for the next decades, you don't really care if the stock market is crashing for 1, 2, or 3 years. You can see here, if you invested at the end of 2007, the stock market was crashing. Of course, it was on the short term, it was painful. But on the long term, you can see here somewhere maybe 2013 or so, it already came up to the all-time highs. And it was rising ever since. Also, when you take a look at the sharp drop during the COVID-19 crisis, it was a very painful downward cycle, but only for a relatively short period of time. So if you have a long-term, decades-long time horizon, this spike down doesn't really matter. Then another strategy you will often hear is that people are often using options, mainly buying put options to secure their positions. So that if it's falling, they have like some exit scenario and can limit their losses. However, this of course comes with a price. And again, like an insurance, you're paying this with a premium. So you need to pay for these options in order to have the protection on the downside. And again, if you take a look at the Dow Jones, up and to the right, short term this might make sense, but long term this strategy doesn't really make sense because the premium that you are paying you could be probably saving over a long time horizon. So, but let me come to the second approach that I take into consideration to hedge my positions. It's showing here at the Intel stock chart. This is Intel Corporation. You can see here it's very nicely rising until the dot-com bubble. But if someone would have invested in Intel during the dot-com bubble, or maybe even during the past 5-6 years or so, they have all been losing money. So even at a very long time horizon, maybe some people are in the red with Intel. Not if you invested maybe in the early 90s or even in the 80s, but if you invested around 2000 or during the past few years, you are significantly down in this position. So what can you do against this? There are other companies out there who have the opposite directions. So this is Apple, for example. Apple, for a very long time horizon, pretty much went up to the right. Of course, if you have a crystal ball to see the future, you could just say you should never buy Intel stock, instead just buy Apple stock. But you will never know the future for sure. Maybe Apple is the next Intel when it comes to the next 20 years. And maybe Intel is the next Apple when it comes to the next 20 years. I'm not saying that this is the case, but it could be a possibility. So how can you protect yourself from investing into a company like Intel? Maybe you can do the same thing that I am doing. I am investing not just into one company, but into quite a bunch of companies. And this strategy is called diversification. Don't just put all eggs into one basket with the risk that maybe you will end up with an Intel stock. But put your eggs in different baskets. Some will be potentially an Intel stock, but maybe others are Apple stocks. And overall, as an average, over time, at least what you should hope for is that you will get this trend here also in your stock portfolio, up and to the right. Maybe it will be more or better than the market, depending what stocks you're picking, how good you are in picking stocks. But if you have some diversification, the tendency should be like this as well. So this is the second strategy that I'm following, diversification, to hedge my portfolio against potential long-term downward pressure. Then the third thing that you can be doing is having a cash cushion, having some cash on the side that in case the stock market is falling, you can deploy the money into the market. Of course, overall, there's a saying, time in the market is better than timing the market. So having a cash cushion is against this principle. But if you feel uncomfortable with the valuation that maybe the stock market is, or if you feel like there is some situation ahead that you are not certain about the future and therefore have some fear about your investment decisions, you can start at least trying to build up some cash cushion. And once the stock market is really crashing, then you just take the money and throw it into the market and buy at least a portion of your portfolio at lower prices. So how you can build up a cash cushion? I think there are two ways. So the active way is you could either sell some of your positions, or you can use a passive way. Passive way is if you have some savings every month, every year, you just build up a cash positions from your savings. So that new savings, you don't just redeploy them to the market, but keep them on the side for a little bit longer and build up a safety net like that. So this is the third strategy that I am doing with my portfolio, just having some cash always aside. And usually I prefer to build up my cash positions with savings. Also, please be aware, as said, the last approach for hedging my positions by building up a cash position is probably not a smart approach, at least if it comes to optimizing your results. Timing the market is usually very difficult to do, and that's basically what you're doing with a cash position. However, if it lets you sleep better at night, then it's probably still worth to do that. And maybe you're lucky and some stocks will be crashing sometimes in the near future, and you can take advantage with the cash that you have on hand. What are your thoughts about hedging your investment portfolio, and what strategies are you following? Please share with us in the comments below. Thanks a lot for joining us today. I look forward to seeing you in the next video, and especially I look forward to seeing you winning financially.